If you believe the stock market is simply a place where people buy low and sell high, you are only seeing the surface of a system that is far more complex and strategically engineered than it appears. Every day, millions of retail investors open trading apps, react to news, follow trends, and try to predict the next big move. But behind this visible activity, Wall Street operates on a completely different level, one that is built on structure, psychology, liquidity, and timing. And most of what drives the market is not openly explained in textbooks or social media posts. The first and most important truth is that in the short term, the stock market is not driven purely by fundamentals. It is driven by human emotion. Fear and greed are the two strongest forces in trading. While companies are valued based on earnings, revenue, and growth, price movement often has very little to do with immediate business performance. Instead, large institutional players understand how emotions move the crowd. When fear dominates the market, retail investors panic and sell at low prices. When greed takes over, they rush in and buy at inflated levels. Smart money uses this emotional cycle to accumulate assets at discounts and distribute them at premiums. This is why the market often feels like it moves against the majority. It is designed to exploit predictable human behavior. Another hidden layer of the market is liquidity. Big institutions cannot simply enter or exit large positions without affecting price. So instead, they rely on liquidity zones, areas where a large number of stop losses, buy orders, or sell orders are concentrated.